Hi and welcome, my name is Jonas Thulin. I'm Head of Asset Management here at Erik Penser Bank, and I will try to as briefly as possible go through our house view. So without further ado, we can skip the conclusion because they're all in Swedish, but the very executive summary is that our house view is unchanged for the last couple of weeks. We still believe in this paradigm shift. They move from a low growth environment, from a high inflation, low growth, to a normal inflation, low growth, i.e. the delta in the equity market, for example, as S&P 500, is plus 25%. This has been our view since Q3 of 2023, hence the Outlook 2023 heading on the slide. And we see no reason to doubt this paradigm. What we think is pretty interesting is that it seems that a lot of people have missed this paradigm shift, which we think is great in the sense that if we're already invested, we're just going to get more momentum behind our positions. Now, if you want to nerd down the 60-40 versus 40-60 portfolio, as you can see now in the blue time series on the right-hand side graph, there's a clear upside momentum. Hence, you have to be overweight equities, and you have had to be overweight equities for the past year. The year ago was the global trough for a number of asset managers in terms of global equities, ourselves included. So for over a year now, we have been overweight equities, and it's been a better call than being neutral or underweight. And what we can see now from the bottom left-hand graph is that the market is a lot more stressed to capture the upside days in the equity market than they're stressed to avoid the downside days. And I think that's great for us that are already invested. Now, in terms of do we see any risks for currently, if we decompose the equity momentum and the yield momentum in terms of monetary news or global macro, etc. As you can see here, there are really no momentum or moves on the downside. So hence, for the time being, we're not concerned at all with our maximum overweight position or our growth tilt. It seems to be very stable. We can skip the sell in May and walk away. As we pointed out a couple of weeks ago, it's complete nonsense. Luckily, this year has proved that to be completely nonsense again, as has been the case for the last, 20 years or something. In terms of inflation, our outlook has been that we're going to reach a 3% handle by this summer. We stick to it. The same models that are listed on the left-hand side in terms of looking for the peak inflation are still showing disinflation or even deflationary pressure. For the next reading, we believe that we're going to break a lot lower than the 4%. We're probably going to be down to 3.1 or even high 2s in terms of inflation. I think that's really interesting, as that will be the last CPI print before the next Fed meeting. Now, after that, it'll be a bit trickier. But that said, when we put our heads out about a year ago and said we're going to reach 3% by the summer of 2023, not many people believed us. But the key back then, June 2022, is that if we're right, then we have to over-allocate to equities. And I think that's been a key strategic call on our behalf. If you look at the Fed's common inflation expectations here in the dark line, we allocated risk at the very peak. Easy to say in hindsight, a lot more fun to do in actual timing. And so far it's been so good. So i.e. the longer term inflation never moved up. If you look at the house pricing, it just has started to roll over. That's going to be with us as a great factor throughout the autumn and go into next year. If you look at supply bottlenecks, we do not at all buy into what Powell said, in the sense that he was claiming that there's been improvement, but we're not back to levels we were before the pandemic. He should just look at the New York Fed's own supply bottleneck measurement, as I show you here in the right-hand graph, clearly showing deflation. This is one of the many reasons why the market thought, nah, we're not going to buy into what Powell is trying to explain as hawkish. There was also one day right after the Fed meeting where we priced in a cut in the July meeting. That's how badly he managed to do that job in terms of the fixed income market. That has been priced away now, and probably a good call. But it's interesting to see how desperately they want to talk hawkish, while it's not really hawkish anymore. And I will show you that in the Fed minutes. Cleveland Fed 1-year inflation expectations 1.3%, almost halved, not really, but almost, in a month's time. So clearly something is unraveling now in inflation expectations, which is quite interesting when we look at Fed policy, because we still believe that the market will price in a cut in 2023. It's going to shift between 2023 and 2024, but there's no doubt that the cuts will come. It's just going to be a market timing play. One of the reasons why we're so stubborn on that call is the CPI is rolling over, wages rolling over, core measurements are rolling over. Hence, there's very little stickiness actually to talk about. China is exporting deflation into the US, huge factor. Housing, China, inventory cycle, wages, none of these is talking about a stable or even growing or troughing inflation. They're all on the downside. Consumer expectations again, but they've done the measurements showing a very low consumer inflation expectation level. Quite interesting to bring with you and going to the fall. Europe is going to tag along with sharply low inflation, but obviously the ECB is going to hang tough a bit more, which is another reason why we think the euro is probably a better bet for us to keep in our global equity market, a global equity portfolio rather than dollars, so we shifted from dollars to euro. And in terms of Fed, yes, they might hike once more. We don't think it's going to happen in July though. And then they're probably going to stake and sort of be neutral or be at the high level for maybe 30 or 60 days before they start cutting rates again. That's just a historical pattern, and I'll show that later on. These are the forecasts the Fed came out with the other week in terms of before and after. And really, what I think is interesting is that they're shifting from soft landing to no landing camp, which is quite interesting, given the fact that there's still 65% consensus for U.S. recession this year. And I will come back to that as well, because I still don't buy into that. I think the Fed is more correct in terms of the forecast. However, that said, the Fed is still hiking rates as the inflation is falling. As you can see now in current cycle, it looks very different from previous hiking cycles. And it's quite interesting. I think that's one of the reasons why the market is looking for a Fed cut. Now, in terms of the Fed language, the hawkishness, if you look at natural language programming, peaked in June 2022. That was then the inflation expectations peaked, and that was about 3 months after the priced inflation peaked in the break-evens, etc., which March 2022. So the idea of the Fed being hawkish or the Fed being blah, blah, I think that's completely irrelevant, and I wouldn't pay a dime for that type of analysis. We think if you want to trade fixed income, I think a lot more goes back to the natural language programming, and we can just basically backride other bigger firms doing this type of work for us. And clearly we can see that we're still long US Treasuries, and we have been since the peak. It was 4.2% in yields, and one of the reasons is that the dovish talk is now net dovish from the Fed minutes. And I think that's really useful to keep in mind when we read newspaper articles or whatever, that we're going to try to depict a hawkish Fed, which is what they wanted to show and illustrate to get the market to move in that way, but not really if you look at the minutes. So they're sort of speaking two tongues here, which is why some would argue they become more politicized than anything else, like Larry Summers pointed out, for example. That said, if we're starting to reach the peak, we all know that historically they've been able to keep that peak for about 30 to 60 days before they start cutting rates, as you can see in the left-hand graph. If the market is mistiming this, as I think the broad market has done, apart from NASDAQ, we believe now the equity market and the up move will actually broaden. I show that in the right-hand graph where you can look at, for example, S&P 500 versus the peak yield from the Fed, and the kind of move you should see going into it and the move afterwards. So clearly we've been underpricing on the equity market. Now this is just the underlying inflation gauge to the left and our inflation, the rate model to the right, where we can clearly illustrate how we try to time the peak at 4.2% and put the position in place, and we actually kept it since then. And yes, we're a bit sneaky, so it's unhedged in dollars. So clearly that's helping this to be a really good trade for us so far. We don't care too much about the signals from the curve, and the reason for that is the market is actually trading where the curve will develop. And so you have the curve in terms of recession probability in blue, and you have where the curve is going to trade and how the equity market is going to interpret this in the dark green. Clearly, you have a clear spread here, but obviously you can trade the two, and they can coexist in a portfolio with the right positions. But it's quite interesting to see that no one really cares about the inverted curve anymore, because everybody knows the future development of the curve, or think they know, I should say. The global peak hawkishness was back in last autumn. And clearly here you can see that on a net, the world global central banks are shifting their focus and becoming more and more dovish as well. In terms of the banking turmoil, to the left I show the deposits, but on the right hand side you can see the liquidity being pushed out in the economy, and our idea then was quite quickly to utilize that increased liquidity and to buy artificial intelligence, and we bought it right to, if you look at the right hand graph, right next to the very tall orange pillar. We bought it, the first step, that was a Tuesday after the thing blew up, and then we added on the Thursday. The reason is that we believed and still believe that that type of liquidity and how it got a hold in the market was enough to kill off and push down financial stress. And you can see, luckily this time around we were right. And so we have a record opening year in our portfolios. If we look back to 2003, we have never had such a strong opening of the year, which is good because now we closed the downside or the losses we made in 2022, both in allocation portfolios and in global equities, which is really good. But we're going to continue to work because now we can actually start to add some real value. But it's quite interesting also to see how financial stress got pushed down so quickly. Combined with this is how you're going to refinance the US Treasury. We think, yes, if the money comes from the RRP facility, good for the equities. Bank reserves, a bit more iffy. Luckily now we can see that money is drawn from the RRP facilities rather than bank reserves. So we're not too concerned about all this mumbo jumbo on social media in terms of the bank reserves, and it's highly correlated to the equity markets, and going to use bank reserves to finance the debt, the hole that was created by the debt crisis, etc., etc. The RRP channel is big enough to completely satisfy the US Treasury needs, and so far that's working as well. So that's obviously a good thing. Now, clearly the banking crisis has wider, perhaps wider economic ramifications, but don't confuse that with the effects that we were expecting to see following the rate increases in 2022. So for us, on the left-hand graph, we can already see that commercial industrial loans should grow negatively due to the rate move that we saw in 2022. The question now becomes, will it be worse or not? So far, we can't really see things developing worse than before. If you look at the recession model built on credit spreads and liquidity, and the New York Fed has done some great work on this, you can actually see a little bit of a move right after the banking crisis, but then it comes back again quite quickly. So to us right now, it looks like, yes, you're going to have a down push in bond corporate borrowing, but that's already due to the rate increase in 2022. It has nothing to do with the banking crisis. And if that holds, then you can be sort of a bit more relaxed. But we're going to keep updating that for sure. Global economic momentum, I think this is still catching people by surprise in terms of the strength of the global economy, and it holds. Nothing new there to say, really. If you look at the data forecasting US recession, yeah, you can't see recession there either. Why do you forecast recession? I wouldn't know. You can't really see it in data. If you look at US in terms of being optimum quadrant, we can see that you have a good economic surprise momentum, a good inflationary surprise momentum. Should we allocate more to the US? Maybe, maybe not. We'll come back with more details on that. But it's clearly interesting now to look at Europe versus the US. Another way of looking at global growth, yes, you can see more bounces and troughs, etc. developing. Global trade, yes, it's back growing positively now if you look at a weekly and monthly data, and very soon on a year data as well. No news here really. You can already see it in traffic in terms of Chinese shipments or the container traffic on the Red Sea, etc., etc. But it follows the global trough that we see all over the place. US recessionary risks are falling for the world economy, back to zero. So we really don't buy into the consensus, and we're happy to take the other side of that bet any day. We try to find the most distorted pricing from that. We've obviously been very fortunate this year in terms of growth equities and tech equities and so forth. In terms of industrial production, we can see the little soft landing, but that's been pushed forward all the time. So you're going to see how this develops. But if anything, that's where we see a little bit of a soft landing. Now, in the blue line time series here, I'll show you the probability of a recession in 12 months' time. What's pretty interesting now is that the consensus is doing the same old trick that we always have done. You know, data, which you can see in the beige line, is surprising a bit negatively. You become more concerned, you make up stories, and you say, yes, the US economy will be in recession in 12 months' time. Now we are 12 months later, and the recession is still not here. So you push it. So it's 12 months, and then 1 month go, and then it's 12 months again. 1 month go, and then it's 12 months again. And then you can start to argue maybe it's just 9 months or 6 months, and that's when you can see different time color schemes going in there. But for us, interestingly, we keep on pushing this recession forward. The Fed is now clearly revising up their GDP forecast, as both IMF and OECD are doing the same thing. So I think it will be interesting when the economics out there will have to shift away from a 65% recession probability to a lot less, which we think could be quite interesting for the equity market. Now, in terms of short-term outlook in the US, stable. The outlook for Sweden picking up, which is great. If you look at the data for the next couple of weeks, yes, we focus on Riksbank, PCE, and PMIs in the US. PMIs in China are stable, nothing really news here. Yes, they're shifting up more liquidity, which I think is good because they're taking back some liquidity from the market. In terms of growth, we're not too concerned about the so-called weak data that people try to desperately prove. If you look at high-frequency data, there's not much weakness there. This is more a financial scheme going on than anything else in our minds. So we keep our long Chinese equities. Right now, we're trending better than the global economy, but obviously we're taking a loss because we've been quite stubborn on that position. And that's why we can't see the slowdown in the Chinese economy. Japanese economy, a bit weird here if you're European to look at what happened in 2022. Virtually nothing happened in the Japanese economy. So right now, this is actually our most profitable trade in our books, some 23%, I think we've done in Japan, which is quite good. We're doing about 3% each week on Indian and Korean equities as well. So things are happening quite rapidly and quite interesting in Asia, given the rebound in global economy and the tech sector. We already talked about the European CPI will come lower. US home builders is another profitable position we have. And you can see the dark line being our model trying to forecast US housing, clearly developing on a positive side, and some position we keep as well. PMIs, they troughed a year ago, no news there. And we still see a quite sharp improvement in the US, which are showing these two types of forecasting models for the PMI, which we see an upside move this coming week actually. So it'll be quite interesting to see, which is also probably very good for the economy, especially if you have a little bit of an idea that we have to broaden our equity investments. The PCE deflator clearly rolling over as well, but I was about to say who cares, but I guess some people would care because there's always this idea that it's not headline, it's not core, now it's PCE deflator, and then it's PCE deflator without shelter or without food or without gas. And we keep on finding, and further away on the bell curve, the data that lags CPI the most in order to argue that CPI has not peaked. But please do remember, CPI peaked June 2022. It's not news. And that also means that the ramification of that peak has gone all the way down to shelter and PCE deflator and core and everything else. Like it always does. There's a huge lag, about a year, but there's nothing news there. I mean, it's just I don't know why people are trying to make that sticky call, especially when wages are falling that low and the consumer expectations are that low, 1.3%. Swedish retail sales, given the credit card consumption, looks to be troughing and rebounding as well. Yes, Swedish unemployment looks a bit iffy, but we already knew that. And in terms of the Riksbank, you have the dotted red line, which is the Riksbank. The light blue was the pricing of Riksbank 3 months ago. Dark blue is the pricing of Riksbank today. So yes, they will hike, but then again, they will cut even more. So the same trend here goes on that we see in the US and ECB. Swedish housing, we have dipped our toes into that and bought a couple of real estate companies. We're a bit encouraged by the bottom right-hand graph. We can see sort of the second derivatives in terms of pricing indicators rebounding. If you look at an evaluation scheme on the top right-hand graph, you can see that yes, it's become a lot cheaper than it was a couple of months ago. But we're still looking at the two left-hand graphs to see something more fundamental happening on the positive side before adding anything more. Europe looks good. We don't care too much about the negative GDP prints. If you look at Germany on the right-hand side, this is a weekly updated GDP model from the Bundesbank. But it's pretty interesting to see, yes, that looks great, but is it enough for the equity market? It has been, but it might not be. So we're thinking about that's a great development from a macro point of view, but we have made that trade and made it work for us. But maybe it's time just to take profit and look elsewhere. We can see more momentum going and more of an improvement in the economy. Because even though that looks great, it might not be great enough. And this is the second leg of the equity rebound that we're starting to see, that you broaden out the equity rebound and you start to chip away former winners and try to find new winners. Europe has clearly been an early winner in 2023, and there might be a time now to start to chip away on that, basically. Nothing new on the dollar horizon. We still think the euro will strengthen versus the dollar and the Swedish will tag along, so we shift a lot of our dollar exposures into euros. A good call given the fact the euro SEK has moved more than dollar stocky. And we keep an eye to the net financial situation on the right-hand graph and the short-term interest rates on left-hand graph and positioning and so forth. And so there's nothing really news on the FX side. On the equity side, we put our necks out here and claim that volatility will fall during 2023. We keep on thinking that. So it's nothing new here really. I think we've been proven right in terms of the equity market and rate market. We haven't had any actual trade on vol. But rather used it to trade tech, for example. Another thing we call, if you look at the right-hand graph, is that we're going to see less downside days in 2023 than 2022. That's one of those forecasts that you're probably 90% chance to be right because it's just a mean reverting time series. But you have to make it, you have to trade on it. And I think a lot of people missed the fact that the equity market was so ready for a bounce. From statistical points of view, that it was quite easy to be swept away with so-called storytelling rather than look at the end of the day, a lot of this stuff is pretty mean reverting basically. And on top of that, you have the daily range indicator showing that institutions are buying like never before. And in the right-hand side, I show you margin depth momentum. That's actually broken into the positive territory. So not only are institutions buying, and they have been buying since June last year, and now they're also putting on leveraged bets. I think it's pretty interesting to see that we still see a little bit of a struggle of people accepting to be overweight equities when everything turned a year ago. A year is a long year to be bearish on equities whilst the equity markets are rebounding. If you look at then at sentiment and flows, you can see that fortunately a lot of people have been on this ride, especially if you look at where they actually allocate money in terms of the sentiment. So clear now in the black here, it's been a very long time since we were this bullish, and we put flows behind the words. Now this is just a risk model showing a clear upside. This is another risk model, it's more nitty-gritty one, so here you can see clearly the banking crisis, the debt cycle, and everything else going back, and you can see how liquidity is very sensitive in this model, which is the whole point of it. But right now it's supportive of equity markets, so we've been holding on to equities. And I should reiterate or remind you that US made new lows following June last year, but we did not. So for us, it's been the right call to stick to equities since June last year. And another good reason behind all this is the smart money index has been climbing, i.e. institutions are buying, retail has been falling a bit. And on top of this, we're also in positive gamma. We haven't been this positive gamma for a long time. And I think this comes back to the idea that people are starting to add leverage to the positions. So when people buy, they probably might use options for that. And so when people sell the call options, they have to buy the underlying equities in order to hedge the call options that they have been selling, i.e. they're actually short. And that creates a positive gamma. And I think I know that's where we are today, and we can predict that gamma, and it looks to be quite solid going forward. So also from this angle, we come quite positive. On the right-hand graph here, I show in the whole U-Bell liquidity ratio that people are still more stressed about missing upside days than they are nervous and they try to avoid downside days. So clearly a positive momentum here as well. If you look at the economic regime model, clear upside again. So as you can see, I can go on for quite some time now, but it's very hard for us to find indicators that you can trade on that actually has a meaning on the downside. I should mention, I skipped this, but the bottom left-hand graph, I know this is a time series people are trying to make a bearish call on. They look at net speculative positioning future and say, ooh, people are very, very short. But then they forget that this is just a speculative positions. If you look at the aggregated institutional asset managers, you can, in the blue, you can actually see that they troughed a year ago, right by when we started adding equities, and they've been moving upwards ever since. And the speculative positions in options from speculative accounts, i.e. hedge funds, could easily be a hedge versus the cash positions or anything like else. So there could be a basis trade going on here. So I think that's a dangerous conclusion to draw, and it's completely hopeless to trade on. So it's one of those graphs I would say we note it, we look at it, we study it, but we don't make a bearish or short position on the back of it. We're still in growth camp. Our models are in growth camp. We think we've been in a growth camp for quite a number of years. So we always keep a tech tilt. And that's important because since 1948, if you look at the business cycle, tech is the clear winner in any business cycle. They can be challenged in a deep contractionary economy by healthcare, for example, or staples. But that's very, very brief moments of outperformance from those sectors. And we try to time those historically, and we try to time them again. But overall, you have to have a huge position in tech is our judgment. And obviously this year, it's been rewarding us like crazy. We still argue that we are 94, 96. We've been arguing that for over a year now. Yes, the economy is slowing, but the equity market won't care. It's already priced. That was our old call, and we stick it to it. So we get this kind of sigma sign going on, like we had in 94, 96. On the bottom of this, our most important call for 2023 was that the trough in earnings revisions and price target revisions and global economy actually occurred last summer. Fortunately, so far we're right. Unfortunately, so far equity market is rewarding us, and we don't really see any larger threats to this view as of today. If you break out earnings revisions and you don't care about forward EPSs or EPS forecasts because they lag the equity market, you can clearly see more upside in terms of the equity market as well. Now a quick word on surprise index, because I know there's a lot of talk about the Citibank's surprise index, as I show you here in the light blue graphs. Yes, it's negative, but the another measurement of surprise index is going positively, the dark blue. The Citi version of economic surprises, they measure economic surprises through the FX market, the spot market. In the dark blue, it's just calculating the actual data versus the consensus. Clearly, the dark blue has statistically more of a relationship with the earnings revision. So when you get contradictory signals today, we choose to tag along the dark blue line. So quick note on that, because it's always good fun to nerd down and see how things are actually calculated in order to see if you want to follow it or not. With those words, I end up there, and I thank you so much for your attention, and we'll be back in a couple of weeks' time for the last video before the summer holidays. So thank you so much for your attention, and we'll see you in a couple of weeks. Thank you.